Hi, my name is David Koenig. I'm the President and Chief Executive Officer of the DCRO Institute. I've been in the risk management profession now for over 35 years, and I'm honored to be included in this program. I want to thank Alexei for the invitation to join you today, but also to join the outstanding faculty that are presenting to you throughout this week. The global reach of this program is impressive, and it's also important that we continue to share our best practices around the world, not just with risk professionals, but with people who are doing the management decisions and the strategic decisions at organizations. And a lot of my focus today is on that. This is a non-quantitative presentation, but in the end, you'll see that there's work for the quantitative elements of our risk functions that's very important to support strategic functions. So we'll get into this discussion shortly. The title of the presentation, as you can see, is Viewing Risk as a Scarce Resource, Boards and the Attraction of Capital, or risk capital specifically. I'm going to talk about a change in mindset that's important for all of us who work in risk and all of us who take risk and utilize the capacity to take risk in pursuit of our corporate objectives. This change in mindset is away from one that's focused on loss and control, and more on one how we use risk to achieve our purpose, achieve our objectives. So that's the focus today. Hopefully what I cover here is of interest to you. And if you get to the end and you find out that there's more you'd like to know about any of the subjects that I discuss, feel free to reach out to me. My contact details are found at the end of the presentation. So let's get started. There are 5 key topics that I want to cover today. First is taking a new view on this concept of firm risk. If you recognize that expression, it's probably through analysis of publicly traded companies, things like beta, Sharpe ratios, risks of an organization relative to a broad market. But what we're talking about here is something different. We're going to take a new look at that, and I'll get into more details. But it's important, again, to reframe our mind about what firm risk actually is in a forward-looking dynamic as opposed to a backward-looking dynamic, which is typical of most risk ratios around publicly traded companies. But what we discuss here is going to be applicable to for-profits, nonprofits, public and private companies. So it's not just about publicly traded companies. Second is how this new view of firm risk, changes our concept of risk governance. So risk governance takes place at the board level, risk management within the organization, but there's governance that takes place at successive handoffs of the risk-taking capacity as well. We'll talk about that a little bit later. The third item is a change in mindset about stakeholders. Now, that term is often viewed as something soft, a concept that people consider to be associated with expectations outside of the corporate objectives of making profit. Well, what we're going to do is look at this in terms of how it integrates well with the idea of making profit at a for-profit entity, but also how it's necessary to view stakeholders in a different way. We're going to view stakeholders as the providers of all the capital we need in order to generate that profit, but also to achieve the objectives that we have set forth in our strategic plans. Number 4 is another new concept for many of you, which is called corporate fade. Now, this is really where we hit the essence of integrating firm risk in the new definition, the allocation of risk capital and risk taking. We'll find out it's a necessity. Corporate fade is something that is common. It's something that's been discovered through a couple of different approaches, and it's something that we can address in our risk management and risk-taking processes, as well as the risk governance at the board level. And the way in which I advocate that we do that is through something called networked and distributive governance of a commons, or here in the short form, networked and distributive governance. So we're going to talk more about that, guide you to more resources as well. But these are 5 key topics to cover today, which I hope then leads you to 3 key lessons to take back to your organization. So I hinted at the first one just a second ago. We have to reframe risk about something that's positive. Most people who work at a management level and a board level don't focus on negatives. They don't focus on loss. And as soon as you start introducing loss as the primary reason that they're going to talk to you, they're really not going to be that interested in it. So we're talking now about reframing risk from not something that's about loss and control, but to something that's necessary. Businesses have to take risk. The only reason we exist, the only reason any organization exists, is to take risk in some form in pursuit of some goals or some objective. And if we don't do that well, as risk managers, you really don't have a job to do. The companies will go away. The second lesson I want you to take back into your organizations is that our success is critically dependent upon these stakeholders. So these stakeholders are part of our organization's social network. I'm going to go into a little bit more detail on that shortly. And their trust in us to deliver on expectations is essential in terms of our ability to avoid corporate fade and to achieve all of our goals, minimizing firm risk or utilizing firm risk as best that we can. Third is that boards, and specifically board risk committees. Now, not all companies have a risk committee at the board level, but I'm a strong advocate for it at any organization with any complexity. Now, I've heard people throw numbers around to say, if you have $1 billion in revenue or more, you should have a board risk committee. I think that's arbitrary. I think the assessment is, do we have complex relationships that determine our success? And to be honest with you, almost every organization does. There's some that you can deal with through other committees, but board risk committees have a very different mindset that's forward-looking and anticipatory. So that's the key here for us to establish an effective risk governance environment in our organizations. So the board's job then is to establish that environment, but also validate that it exists through management. So take these 3 lessons back. That's what I'd like you to do today. So this is the current state of the world. Uncertainty around health risks, primarily from COVID, but there are certainly health risks that emerge in diet or cancers or other things that spread. Health risk dominates most of our discussions today. Geopolitics, there's a changing dynamic throughout the world, as we've seen in the US, Asia, anywhere that there's conflict over resources and political influence. And we know that's going to continue. The environment is changing. We see stronger hurricanes, typhoons, we see greater rainfalls, we see greater heat, fires, whatever it may be. We're all fairly aware that there is climate change happening. And the understanding of science is that this is going to continue and probably worsen, certainly for the next decade, maybe even 2 decades, while we try to address it. But the environmental risks are out there and they're going to continue to grow. Technology risk, whether it's from AI, whether it's from quantum computing, whether it's from the changes in how our data is protected or accessed, or cyber risks. This presents a new challenge and a growing challenge for all of us who become more and more digitally dependent. Financial risk will always be there. There's always something contributing to new financial risks. Presently, in response to the COVID outbreak, we've seen massive increases in government debt, particularly here in the US. And the question is, does that lead to some sort of dramatic response later? Competition is always there. And I want to get back again to this notion of geopolitics, because one of the things that came out of the intersection of geopolitics and COVID is that supply chains and other networks on which we depend became far more obvious to us, and we realized their critical nature in our success. So the question is this risk? Well, you heard me earlier talking about how we need to reframe risk to a more positive view. If this is what we're talking about, and I have to note that this slide came from a presentation I did almost a year ago, and not much has changed. If that's our focus on risk, we're really not going to make much progress, because risk isn't going to change that much in the negative sense. How we respond to it, how we utilize our capacity to take risk, how we look at risk going forward, particularly things we don't know about, that's going to determine our success. So let's get to this idea of reframing firm risk. Credit to this goes to Bart Madden, whose book I'll reference later. His book's called Value Creation Principles, but Bart's been around since the 1960s. Bart's created cash flow return on investment metric, which a lot of investment analysts are familiar with. But his latest focus is on this idea of knowledge building and firms' ability to continue to thrive. So in his view, and I agree with this, I think it's a really important change in mindset. Firm risk is anything that stands in the way of achieving our purpose. Now, you might think that means just bowl over everything that's in your way, but it's not. It's really looking at the processes and the ability and the opportunity to innovate, change the way in which we do things, identify bottlenecks, and address those. That's part of what comes out of this view of firm risk. It also is something that we need to view as being necessary. This idea of innovating and improving is always necessary, or we will experience something I'll talk about in a bit, which is corporate fade. And corporate fade, as you can guess, isn't a good thing for us. And the last thing I'll say about this is that this notion of firm risk and risk generally and risk capital allocation should become part of the everyday discussion at business. We talk about market share, we talk about customer needs, we talk about the political environment. There are all sorts of factors, cost of employees, all of these things that go into our daily business decisions. Risk isn't there on a daily basis and isn't generally considered to be part of the overall framework of making good business decisions, in part because we haven't enabled it to be so. We haven't made it into a positive, which again, we'll talk about just in a second here. So when we put risk in the context of loss, we generate fear. We generate some impulse in people that's more defensive. And so the psychology of risk, there are a few things here I want you to make sure you understand. When we focus on risk-taking as a negative, it can create fear and cause us to be unwilling to act. In other words, unwilling to take risks. And as I was saying earlier, we have to take risk. If we don't take risk, we're going to go away. So one of the things we also understand from the study of the psychology of risk is that if we're talking about big downside risk, and that list of risks that I talked about before, forward-looking risks that are all on the loss side, some of those are quite substantial. They have significant downside to them. What we've found is that as human beings, if we're presented with the possibility of large losses, we're only going to be interested in taking risks that offer 2 to 3 times the gain of that perceived loss. What that winds up doing is removing all sorts of good ideas that generate positive returns and good uses of capital, but don't in our minds generate sufficient returns. It's a fallacy. It's something that our response to risk that's deeply ingrained in us causes us to do. So again, we want to get beyond this. When we're focusing risk as loss, or when we're framing risk as loss, we can generate this kind of response. The other thing when we have fear, again, of loss or that we're being attacked, is we lose our rational thinking. We tend to go towards short-term responses, which are all about survival, and not about long-term strategic thinking, which again is necessary for our organizations to achieve our goals, especially at the board and senior executive level. Now, I want to talk to you about stakeholders and the capital system and the capital that we need to raise to achieve our goals, to even pursue our goals for that matter. The diagram that you see on the screen in front of you now is a representation of different stakeholders in our organization. I refer to it as our organization's social network. Every entity you see on here has some way of influencing our success, some way of influencing whether we are going to be an organization that people look to favorably and see that has been successful, excuse me, or an organization that didn't make good use of their resources. All of the lines on this chart represent communication. So each of these entities is able to communicate with themselves. And this is a very simple diagram, but you'll recognize most of the names on there, and a couple of them you may be surprised to see. We're not going to talk about that in great detail here about some of the entities that are on here, but I'm happy to have that conversation with you, or you can read about it in other places and other videos I've done. Again, this is a simple representation. Let me take you to something that's closer to reality. Now, this is the actor Kevin Bacon's social network as I modeled several years ago, and you'll see in books I've written. And this is a really tiny subset of his social network. Now, all of the people who are pictured here, all of the entities that are pictured here have lines connecting them. That means they have influence over the value of Kevin Bacon as an actor. You can substitute his name out, put your corporation or your organization's name in the middle, and you have a social network just like this. One of the interesting things about this is a lot of the communication in this social network happens around the middle, not through the middle, around the middle. And so how we influence one of these stakeholders may influence myriad stakeholders without us ever having any contact with them. So good to keep this in your mind. This is a complex social network, a complex adaptive network that our organizations operate in and depend upon. That's really important to remember. Now, when it comes to allocating capital, or for example, just doing business with someone, everyone uses what's called a value equation. Many of you who are watching today actually do this with an equation, but most of us do it through heuristics. So heuristics are feelings, thoughts, responses based on our past experiences. And some of them are hardwired into us, like the one I talked about before in terms of fear of large losses. Now, the value equation has a couple of components to it. The first on the top, the numerator, that's what I'm going to derive from a relationship that I have with whomever I'm engaging with. So in the case of, say, a capital allocation to a stock, publicly traded stock, the returns I'm going to get are in the form of dividends, or I may sell the stock at some point. That could be capital gain or capital loss, but I'll get something back. In the terms of issuing debt, these are coupon payments or cash flows off of that debt. Anyway, it's a relationship that returns something to me, and it could be a relationship with a friend even. What do you get out of that friendship? What comes back to you? Now, the more interesting part, I think, is in the denominator. These are DRs here, or discount rates. As you know, anything that happens in the future isn't worth the same as if it happens today. So we need to discount what we might get in the future by some discount rate. Now, this discount rate is driven by a number of things, which include our expectations around risk. And it's primarily the risk of being disappointed. So we have expectations about what we're going to get. So if it's a government bond, pretty sure what we're going to get. But if it's a new job, or if it's a friendship, or if it's an investment in equities, we're not entirely sure what we're going to get. So we have to discount that back based on some expectation of the likelihood that we might be disappointed. That's how we determine the value of relationships. Pretty simple, pretty straightforward, but universally true. Now let's look at this cycle of capital provision. And again, think, this is not just financial capital. This is not just debt and equity. This can be whether someone is going to provide their intellectual capital to you, whether they're going to provide their human capital to you as an employee, all sorts of things that come into this. So we begin with capital attraction. You have an idea, you have a purpose, you have something you're trying to achieve. At a startup, that may be singular. At a corporation, it may be multiple projects within the company competing for the capital that's available to be allocated. But you have to attract that. You have to make some case for capital to come to you, or it's going to go somewhere else. There are others who want your capital or want capital from these networks. Now, utilizing that capital is in essence effective risk taking. So we use the capital, take risk in pursuit of our goals, and we hope that we're good at doing it. That's the whole point of coming together. And if we are, it provides some sort of reward to the capital providers. Stock price might go up, and people might get their debt payments back early. If you're an employee, your career salary might go up. You might have the benefit of a corporation, the glow of a corporation that does well on your resume. These are positive things that come back to you. That's the reward for your allocation of capital. But you're not done. You're about to allocate capital in a continuous process. If you're an employee, you're going to come into work tomorrow. If you're an equity investor, you might consider investing more or reallocating your investment. So now we get to anticipated risk, which is the discount rates that you saw in the value equation. This is the equivalent of trust. How much do I trust that you're going to deliver on my expectations as the recipient of my capital in whatever form that is? This is what they refer to in psychology as a feed-forward mechanism. So reward is feedback. We're all familiar with that. We say, if you pay someone for success, that's feedback that'll encourage them to do the same thing again. What's surprising is feed-forward is more important. Feed-forward is the anticipation of the future, which has the heuristics and the emotion that we talked about before. It's where the irrationality around risk comes in. And so this is an incredibly sensitive point for capital providers to determine whether they're going to give you their capital or if they're going to give it to someone else. So we really need to focus on trust and this feed-forward emotional reaction that people have in talking about risk. When we're successful in this loop, the continuous loop, we create value for us as well as the people who are in our network providing us with capital. So let's take a look at this. Let's think about it in the framework of a stock price, which is what we have listed here. We have past experience with a stock price up to that thick black bar. So that's the history. It's pretty good, but there are some episodes in there where money was lost if you sold your investment at the wrong time. But the analysis I'm probably doing in terms of my investment, maybe 1 year forward. In this case, it's an example, 1 year forward. It could be 5 years forward. It depends on your investment horizon. I don't know what the value of that stock is going to be in 1 year, but what I do have a sense of is the possibility. What I'm showing here is a distribution of possible outcomes. These are different paths that the stock price might take. Now, if that's the case, I can actually bucket these in a way that looks at it as a distribution. So I have a distribution of future prices, which has a shape to it. So that shape is what shows up on the right. This shape is really what is going to compel me to use that feed-forward mechanism to determine whether it makes sense to have an investment and allocate capital. So I'm interested in 1 year forward, feed forward, the distribution and the shape of the distribution of those possible returns to me. That shape is really important. So now we're going to talk about that shape. Conceptually, the idea here is that if we can create a positive skew to that shape versus a negative skew to that shape, we create something that has a higher expected value. It's even, if it's a positive skew, it's a higher expected value than just a random choice. So what we're looking at are ways that we can increase the size of the tail to the upside and reduce the size of the tail on the downside. Remember, the tail is where big losses happen. And what I talked about before is that when there's the possibility of big losses, we may demand 2 to 3 times the return. In other words, we will charge more for our capital. We want to focus on that downside. We have to as part of our work, but it's not the main focus or the only focus. We also are focusing on the upside so that we generate that right tail and get this positive skew from anyone considering providing their capital to us. So now this fade idea that I talked about before, this comes out of Bart Madden's book, Value Creation Principles, which is shown on the left. But then there's this idea of corporate fade that came through the work of, and there you see it in this screen here, this idea of corporate fade came through the work of a physicist as well. And I'm going to talk about that in just a second. But fade is this idea that early on when you have an idea, you're going to generate negative returns on an investment until it becomes successful, and then you have very high positive returns. That attracts competitors. It might attract complacency. It might mean that you start to invest irrationally or unnecessarily in that product in ways that aren't efficient. And eventually what we see is a whittling away of the return on capital back down or even below the cost of capital. This is a very common cycle we see in corporations. And as I mentioned, the physicist Geoffrey West found this exact same pattern in companies when he asked the question not about cash flow return on investment, not about return on capital, but asked whether corporations had life cycles that looked like that of mammals, humans, other animals, or cities. And cities live on. Cities have endured nuclear bombs. Cities are innovative, complex systems that continue to grow in most cases. What he found is that corporations have the life cycle of mammals. Grow fast when they're young, level off, roll over, and die. It looks very much like Madden's chart here of fade. So we have a finance person in Bart Madden. We have a physicist in Geoffrey West, both identifying the same problem with companies typical for their life cycle. We have to have capital to pursue this continued growth. So let's think about the way in which we then use that capital. So I mentioned earlier, the model I use is something called a network and distributive governance of a commons. And there are 3 aspects to that. So the distributive element is something called something that comes out of the Carver Model for corporate governance. Now, the book that you see pictured there is called Governance Reimagined. I wrote that originally in 2012 and updated it in 2018, or second edition in 2018, with some slight updates. I'm really happy. It hasn't needed a lot of updating, but this concept is all built out, and all the discussions I've just had about risk are built out in this book as well. But the Carver Model is something called nested bowls and nested policy bowls. So the graphic that I just put up is a series of bowls nested inside of each other. What I want you to do is think about the very big bowl on the outside being the policies and objectives that are set at the board level. And at each successive level of the organization, the CEO handing off to their C-suite, the C-suite's handing off to their business leaders, all the way down to the people who face our customers, they're given the objectives as a subset of the big objectives of the organization. They are given rules in terms of pursuing those, things they're not allowed to do, that are smaller subsets of the things you're not allowed to do as established by the board. So these are not what you have to do, they're what you can't do. You're allowed to do anything within those rules, anything within your bowl in pursuit of the goals that have been set for you. So that's the Carver model of corporate governance. Now, I'm not going to go into some of the failings of that model here, but you can read about that in the book or other presentations that I've done. Now, the second thing is this idea of creating a market for risk taking. And this is where some of the analytic people who are watching today will have a big role. When we allocate the ability to take risk, we also need to allocate risk capital. And there has to be a market for it. So if we're competing in the open market to get human capital and financial capital, we should have competition within our companies to create that. So that's, again, the distribution of capitals. That's the distributive part of this. But there's a competitive aspect to it as well. Now, we're trying to create something like a venture portfolio investment in our organizations. Our portfolio is a portfolio of ideas, and those ideas come in from our company, but they also come in from outside of our company, and that's some of the networked aspect of this model. So you saw the picture out of Kevin Bacon, his social network, our social network. There are ways that we bring this in through stakeholder committees and engagement of these capital providers who are stakeholders. And then we're looking to identify something called commons, or common pool resources, things like brand and risk capital, to which we all have access, but if we abuse it, we can damage the entire organization. So again, I'm not going to go into details on that here. It's in the book, but it's based on principles developed by Elinor Ostrom, who's a Nobel Prize-winning economist, who looked at the best way to govern organizations, govern environmental common pool resources, and found some common themes. So what we're looking for again here, distribute the ability to take risk, charge for risk capital in a competitive market, bring in our networks and the ideas that they have into both our governance and management structures, and then look for these common resources that we all have access to, that are all precious, and implement these rules for managing that successfully. So engaging our stakeholders, again, really important because they're all part of this capital process. We need to engage them at almost every level of the organization. But the board is the place to start. So the board is trying to create the environment, the biggest bowl that I'd talked about before in the previous slide. The board is creating the culture, the environment, the rules for things you can't do, and the large objectives that we're trying to pursue. So from a board perspective, same things apply. Same rules apply as they do from a management standpoint, but the board has one employee, and that's the chief executive officer. So the handoff is there. The network, on the other hand, helps the board keep track of the chief executive officer by bringing people in outside of the organization and inside of the organization that can validate what the CEO is representing to them, or bring new ideas in that they can use to challenge the CEO or look at new strategic objectives. Both of those covered in the book, but they're essential not only at the board level, not only at the management level, but also at the board level. Now, the DCRO Institute came out of the Directors and Chief Risk Officers Group, or DCRO. One of the things we put out was something called the DCRO Guiding Principles for Board Risk Committees. Where this environment for risk-taking is created is typically at the Board Risk Committee, which ultimately feeds to the board as a whole. These guiding principles are available for free online. I highly encourage you to download them, or if you can't find them, send me an email and I'll send them to you. These aren't pie-in-the-sky ideas. This is written by board members and chief risk officers with very practical elements of how to implement effective risk committees at your board level so that you can create this environment. Really important document, really valuable document, and it's out there for you to have for free. So let's get back to this again. The discount rate is a function of perceived risk, the feed-forward mechanism, trust. How much do they trust you to meet your expectations? It's far more important than any reward mechanism. So all these risk measures, Sharpe ratios, betas, all look backwards. That has almost nothing to do with the future because the organization is not the same going forward. The environment within which the organization operates is not the same going forward as it was in the past. It's sort of a false hope to rely on past data to predict the future. Anybody who's ever read a disclosure document from a commodity investment or an alternative investment knows that that disclosure about the future is in bold print and capital letters. Why we don't think that same way in the boardroom and why we don't think that same way when we're doing investment analysis is beyond me. But the idea is the feed-forward mechanism is multiples more important than the feedback mechanism. So how do we signal trust as an organization? Well, past results or volatility, right? Are we reliable? Is the experience you have when you go into a store to shop the same each time, or do you sometimes get treated well, sometimes treated badly? If it's the latter, you're less likely to go back to the store. Same thing with any relationship with the company. Is your track record one that they expect to continue? Do you offer transparency? This is where our network coming into our governance model is of great value. If we're willing to bring people in to talk about our strategic planning, particularly customers that are highly valuable to us, or those, again, upon whom we rely to provide us with capital, that transparency builds trust because they can see that we have expertise and that we're being very thoughtful about this, that we have a functional response to surprise, a problem response team, that we've thought through gray rhinos, black swans, all of those things that potentially cause disruptions in the environment that we have. And we don't know exactly what those disruptions will be, but we've created a mechanism for responding to them. So getting back to that positive or negative skew to the future distribution of outcomes, it's this functional response to surprise that helps to truncate the left side of the distribution. So we don't focus just on loss. What we do is focus on how we'll respond to surprises, which gives us the confidence to take risk. This is really critical for us in building trust. Creditworthiness, obviously we communicate that out to the people providing us with financial capital. And then getting back to Bart Madden's work, continuous innovation. Always thinking, what kinds of risks can we be taking that could generate future innovations, could generate future positive returns on capital? Which ones do we do? How many do we do? What's our success rate? And surprising to most, venture capital portfolios typically have a 20 to 30% success rate on their investments, but they generate among the best risk-adjusted returns of any investment. We really want our organizations to become like that. They have a knowledge building loop where we're continuously investing, continuously innovating, expecting to follow a curve for every innovation like Madden had described, and realizing that that's just a normal part of the business. And again, the way in which I advocate that we get there is this network and distributive governance of a commons model, which is described in the book. But I've made this book available for free. The book from 2012 and 2018. It's available for free. I'm happy to send you a copy of it. The digital version's free, and it's all described well in there. So if you want to go into a little bit more detail about how this reshaping can be done, this slide links to a video, or you can find this video on my website, where I took a portfolio of companies that were selected by Charlie Munger of Berkshire, Carl Icahn, George Soros, Bill Ackman, some fairly well-known investors in the US, and asked, if we did this kind of analysis on companies based on the data that I had, can we improve their portfolio? And what you find is that there's a consistent outperformance, consistently lower risk when you take into account concepts around risk governance. So the three key lessons, again, to take back to your organization. Our organizations exist to take risk. Otherwise, there's no reason to come together. There's no reason to be drawing this capital. So risk has to be embraced as part of why we exist. Our success is critically dependent upon stakeholders. Stakeholders are part of our social network, and their trust in us will determine the cost of capital that we have to pay. Return on capital is not enough. Return on capital has to be in excess of our cost of capital. And to the extent that we can focus on reducing that cost of capital, we put off fade even further. And our boards have to establish through that big bowl that we talked about in this nested model, the environment and the culture where we can effectively take risk. And they do that through the processes I've described before. So actions to take forward today when you go back into your office. Talk to your organization about how to reframe risk, whether this is your risk management department, your management committee, or the board. Reframe it with a focus on upside and the necessity of risk taking, but work on the resiliency on the downside. Build a market, and this is again where the quantitative people who are watching can come into play here. Build a market based on the cost of capital that the firm realizes relative to the risk that these particular venture internal venture portfolio investments might require. your ability to describe and to a degree quantify the risk of disappointment, the organization's risk of disappointment in these different projects and ventures is going to be incredibly valuable, because we want to start turning risk taking into a cost like any other cost we have in the organization. So that when we create this business line to compete, they're going to pay a price for the capital, and that's just like the cost of human capital. It's just like the cost of marketing, any other cost that goes into determining whether the organizations could be successful. As a risk manager, then, you become an advocate for their success. They begin to trust you as someone who wants the organization to succeed, not someone who's trying to point out what they're doing wrong, and not someone who's continually pointing at failures. We want that high trust environment where we can have this networked and distributed model of governance. If you don't have trust, you can't run this model, because this is an empowerment model, empowering people to take risk within the boundaries that have been set for them. You have to trust that they will stay to those limits, and you have to trust that they will make good use of that capital, and they have to trust you that you'll stick to what you told them they could do. Now, we always want to focus on the long-term impact of our investing on trust in all capital providers. So again, human capital, intellectual capital, financial capital. And back in that slide, when I looked at, I showed those who are involved in our network in a very simplistic way, some of you may have noticed that I had regulators listed up there. Now, you might think, how is a regulator a capital provider? Well, you have a degree of freedom to pursue your goals. Regulators determine how much of that freedom you have. So think of them as being the providers of freedom capital, for lack of a better term. They have the ability to restrict the freedom you have to pursue your objectives. So to the extent that they trust you to be following the rules, to have a resilient enterprise that's constantly innovating, constantly generating positive returns, will give you greater freedom to pursue what your objectives are. And again, transparency and effective communication to all your capital providers is one of the keys to building that trust. So as I said, a lot of this stuff we're talking about in a very high level today. A lot of it is available in my books, Bart Madden's books, Jeffrey West's books, resources from the DCRO, and others that are speaking at this conference. But if you want to talk further about it, here's my website, here's my phone number, email address. Don't hesitate to reach out to me. I always enjoy conversations where I learn about something other people are doing in their work, and if I can provide any further insights on what I do, and particularly what the DCRO Institute is doing around helping to bring risk expertise to the boardroom and the C-suite, I'm very happy to do that. Again, thanks to Alexi for the invitation to join you today. I hope this is something that's been of value to you, and look forward to some conversations in the future.